got to talk about this because the market's become absolutely merciless to the formerly high-flying stocks of companies that report what some people think are suboptimal numbers. I don't think they are. Take Zebra Technologies, ZBRA. It's the maker of specialty printers, including thermal label and receipt printers, along with lots of associated software supplies, radio frequency identification solutions, and Motorola's old enterprise business, Simple Technology, that bought for $3.5 billion, deal that closed a bit more than a year ago. This acquisition was supposed to be a game changer because it made Zebra a leading player in mobile computing, barcode and mobile printing, data capture, location, motion management solutions, cloud-based device management, the Internet of Things. Now, initially, Zebra was on fire with its stock roaring as high as 117 over the summer. But then in August, Zebra reported what people thought was a disappointing quarter, caused the stock to plunge nearly 24% in a single session. It's been pretty much downhill since then. At the time, management blamed much of the company's weakness on one-time problems. Then Zebra reported again yesterday, and while the company delivered a strong 16-cent earnings beat off of a $1.23 basis, revenues that came in just a tiny bit light. What really matters here is the guidance for the next quarter, which was lower than the analysts were looking for, and the stock got crushed, falling 8.7% yesterday. At these levels, Zebra's selling for just under 12 times next year's earnings estimates. At a certain point, you got to start wondering whether this thing has become a value play, or is it too soon to start bottom fishing because maybe the estimates can't be met? Let's take a closer look with Anders Gustafsson. He's the CEO of Zebra Technologies. You hear more about the quarter and where his company's headed. Anders, welcome back to Mad Money.
Thank you.
All right, we got to solve this puzzle because I've gone over it. I've got my notes. I went over the conference call. I listened to the conference call. I think there's a disconnect, and I'm not that I can get you to do a do-over on Mad Money, but I think that there was some confusion on the call about exactly the synergies that you were talking about and the growth rate, because I can't get to 12 times earnings, and I just want you to walk through. You're at the heart of Internet of Things. I want you to walk through what happened in the transaction versus what the analysts seem to think is happening.
So far, we've held the same long-term model intact. Right. So, when we announced the deal, we said we expect to be able to get $150 million of synergies by the end of 2016, and we will get to an earnings model of 4 to 5% revenue growth and EBITDA margins of 18 to 20%. And we've upped our synergy target, but we have not changed the model per se.
Right, see, that's what the confusion is, because, I mean, for instance, when I was looking at what the incremental acquisition costs were, some people felt that you guided incremental acquisition costs. You said the firm expects total $200 million in cost synergies by 2016. We got that. But incremental acquisition-related costs of $180 to $200 million. Now, is that right? Because that confused me.
Yeah, so what we decided we wanted to do is that we wanted to give a sense of, from today, what's left. So this
what's
is
left to have
what's happened.
Okay.
So it's not from the beginning; it's from today. So we said $180 to $200 million, including capex, to complete the integration of all the of the companies. Right. So that is somewhat incremental to the original targets, but as part of that, we also announced basically $50 million of incremental synergies, and we said that after we're done with integration, we will also then be able to gain greater efficiencies. We would have an IT system that's much more cost-effective and efficient, drive less annual ongoing capex, and we would be able to drive an increased 50 to 100 basis point of gross margin and 200 to 250 basis points of EBITDA.
Now,
OPEX leverage.
Okay, see, I typically don't go into this kind of level of granularity on the show because I think that you're right in the middle. Everyone knows you as barcodes. You can read them. There's a fabulous video on the website. You just press it. It's a 2-minute video. It tells you exactly how they're in the center of everything. But I know that it looked like to me that you, at one point on the conference call, say on the negative side, the complexity of the information technology systems had been greater than expected. It made me think that, look, as interesting and as important as the Motorola acquisition was, maybe it was a little more difficult than you thought.
Well, I think we still feel very good about the overall transaction.
You really do, but you're obviously you had reservations in retrospect.
Only with respect to the complexity of the IT integration. Okay. But apart from that, our revenue is running very strong. The customers are liking the story. We are winning in the marketplace, and our profitability is good.
Yeah, because I mean, we're looking at this NFL football thing behind you. That you guys are there. I mean, now I just want to back up out of the get out of the to the forest from the individual trees. I mean, it really is true. You are the market leader. There's really no one. I know you mentioned there's some Chinese competition or something, but there really is. Who are you really up against?
Well, there's always a competitive market. There's many different players in there, but we are the market leader in our three main products categories.
Right. And you're also, I think, you look at the legacy business growing at 8%, enterprise 5%, then you get a 12 times earnings multiple. Again, I'm trying to puzzle over why your stock is where it is. And I've come to the conclusion, tell me if I'm wrong, that next year at this time, a lot of what we're talking about right now will be history, and you'll be looking at the market leader in the Internet of Things that really is able to handle all the mobile and all the mobile technology and cloud technology on a wand, on a handheld wand.
I certainly hope that you're right. I mean, we feel very confident and very enthusiastic about being able to execute on the plan that we have laid out. And eventually, I think the market will come around.
Do you think that the expectations are finally wrenched out? I know there were some people who got ahead of themselves because they saw this combination as being so perfect. Do you think that that's all gone now and everyone's pretty realistic about what you can do?
I believe so.
Well, that's very important. And do you think that there's a possibility? When I look over one of the slides that you have about all the different things, you said achieve synergies, execute on integration, identify key areas for further growth, and then de-lever the balance sheet. Will you be generating enough cash that I can see a much better balance sheet next year at this time?
Yes. So this year we paid off $150 million of principal. We said we're going to pay off another $300 million next year.
You think you can do that?
We believe we can do that.
Geez, then it'll be a fast-growing stock.
And $650 million in the next 2 years.
Fast-growing stock with a much better balance sheet and all integration fixed this time next year.
It should be.
All right, I hope so. That's Anders Gustafsson, CEO of Zebra Technologies. I am urging you, before you think about buying this, you click on that video. You will see exactly what they do. You can't believe how at the heart of the Internet of Things this company really is. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.